Hi, this is Karen Lin. In this video, I'll introduce long-term liabilities and their accounting recognitions. What are long-term liabilities? Long-term liabilities are sources of resources and they do not have to be paid within a year. As I said, if a long-term liability, say a 5-year bond, approaching to the end of its maturity, say next year, within 12 months, it has to be paid back, they will be reclassified as current liabilities. We'll talk about bonds payable and notes payables. But I'm going to focus on bonds payable and the bonds issuance. What is a bond? A bond is basically a written liability to repay the debt at some point for some rates. So let's assume Lowell Corporation issued bonds with a principal of 1 million, okay? And the life is 10 years, annual interest rate 12%, and the bond interests are paid each year, every half year, so on June the 30th and December 31st. You can see this structure is that Lowell Corporation borrowed 1 million from another company, issued a bond, or other investors issued a bond, $1 million, and the bond's life is 10 years, and there are 20 payments of interest, right? Because 10 years, every year you pay twice, that's 20 payments of the interest. So when the company first issued the bond, they debit cash, credit bonds payable 1 million. Okay, they get cash because they borrow money from outsiders and they have some debt to be paid in 10 years, so they credit bonds payable. Now let's talk about how we calculate interest expense. Let me talk about how much we have to pay every for the interest. So we borrow $1 million from the investors. We issue a $1 million bond. The annual rate is 12%. So 1 million multiplied by 12% is how much we need to pay every year. But the company is paying every 6 months. So every 6 months, basically it's half, right? 6 over 12 is half. We are paying half year of interest. So that is $6,000, which means for each check we wrote to our debt holders for the interest, that's $60,000 each payment. Because we are paying this interest for 10 years, every year we are paying twice. That's 20 payment of $60,000 added up to be 1.2 million. So at the end of the day, we are paying 1.2 million interest over the 10 years course. We are paying back the principals 1 million, right? We are paying the principal 1 million. So adding up these two numbers added up to be 2.2 million payment altogether. So over the 10 years and plus at the end of the 10 year, we are paying back 2.2 million in total. At the beginning, the company received on July the 1st 1 million, right? That's when we receive cash. So we are paying back altogether 2.2 million. We received 1 million. That means the cost of borrowing is the 2.2 million minus the 1 million. That's 1.2 million. Okay. And how much is the cost of borrowing per year? That's the total cost borrowing divided by 10 years. So 1.2 million divided by 10 years, every year it's $120,000 payment, cost of borrowing per year. If we want to even drilling down to per month borrowing cost, that's 120,000 divided by 12 months. That's $10,000 per month. Okay, you will be surprised why I'm using such a difficult way to calculate cost of borrowing, because you would say, well, the cost of borrowing is just the 1 million multiplied by 12% per year multiplied by 10 years. That's 1.2 million. Yes, you are absolutely correct. But I want you to pay attention. This is a case where we borrowed the money and we issue the bond at the same amount. We call that issue at the par value. In a minute, I'll talk about if we issue the bond at a premium or if we issue the bond at a discount. You need this formula to calculate cost of borrowing for each month. Okay, so I just want to leave it here. Although you could have just used 1 million multiplied by 12% and multiply by 10 years. That's 1.2 million. That's absolutely correct. Okay, so to record this, if we have a monthly reporting system, is that for each month, we are going to debit interest expense, credit interest payable for 10,000 per month. Every 6 months, we are paying back the interest, right? So we are going to debit interest payable, 60,000, credit cash, 60,000. So we basically cancel out whatever we have been accumulated in the payable account every 6 months. We are going to cancel it out and pay that by cash. At the end of the 10 years, we are going to pay back the principal as well. So we are going to debit bonds payable. We are going to credit cash for the principal. You can see we have been made 20 payment of $60,000 plus one last payment of the $1 million we have borrowed. So this is what we call issue the bond at the par value, which means whatever we borrowed, we issue the bond at the same price. But sometimes we can issue bonds at a premium, which means we are issuing the bond with receiving more cash than the principal indicates. Why is that the case? That is the case when the bond's interest rate is greater than the market interest rate. For example, we are paying 12% annual interest rate while the bank is paying 10% annual interest rate. So the investor will feel, well, if I deposit the money in the bank, I might as well lend the money to this company. So in that case, the demand for the bond is greater and the price of the bond will go up. So that's the basic supply and demand idea. So let's assume Lowell Corporation receives 1.12 million when it issued the bond, which means they will be paying back 1 million at the end of the 10th year, but at the beginning they receive more than they are paying back in principal. They are still paying interest, but they receive a little bit more than they issued at the face value of the bond because they are paying a greater interest than the bank or than the market interest rate. So when we record that bond issue at a premium, we would debit cash, obviously, because we received 1.12 million cash. We will be credit bonds payable. Note that bonds payable will stay the 1 million because at the end of the 10th year, we are paying back the principal 1 million. So we cannot record 1.12 here because at the end of the year, 10th year, we are paying 1 million to the creditors, which means the difference between the two goes to an account called unamortized premium on bonds payable. So this is the premium, which will be amortized every year. When I'm saying amortized, it means just something just like depreciation of your assets. We have talked about in chapter 9. It is sort of it will be depreciated in the next 10 years. Okay, so I'm going to record it in a premium that's not amortized yet. Okay, so that's the accounting recognition. Now let's again calculate the interest expense. So let's start with here. It is the same. We borrowed 1 million, 12% annual rate. Every half year we are paying the interest. So every check we are writing to the creditor is $60,000 for 10 years. So that's 20 payments. That's 1.2 million. At the end of the 10th year, we are paying back the principal, which is 1 million. So altogether, we are paying back 2.2 million as before. You can see that we are still paying out 2.2 million as before. However, we received more than the principal indicates. We received 1.12 million because our bonds are issued at premium. So using the money we pay out minus the money we received, that's how much in total we pay out to the creditor. That's 1.08 million. That is the cost of borrowing. Now you see why I did something like this in my first case, although it looks like you can do it in a simpler way. So anyways, I'm calculating the cost of borrowing 1.08 million for 10 years every year. That is $108,000 per year. Divided by 12 months, for every year, the interest expense will be 9,000. Okay, again, using the money paid in 10 years minus the money we received at the beginning, we got the interest, we got the cost of borrowing for over the 10 years. That could be drilled down to annual cost of borrowing and monthly cost of borrowing. So this monthly cost of borrowing would become the interest expense. So I'm going to debit interest expense 9,000. I'm going to credit interest payable 10,000. Why? Because every 6 months I'm paying 60,000, right? So for every month, the interest payable, which means interest accrued to be paid in 6 months, for every month, it would be 10,000. So I'm going to credit interest payable 10,000 because that's really how much I will pay using cash in 6 months. And I'm going to debit the difference between these two, $1,000 as unamortized premium on bonds payable. That's $1,000. You can see I'm basically written off this unamortized premium on bonds payable. Every month I'm written off 1,000, right? So I'm going to write it down. So each month I'm going to write it down here. Each month I'm written off 1,000. So each year, this means 1,000 multiplied by 12 months. That is 12,000 per year, right? And then each over 10 years, we will be written this off by $120,000. Okay, you can see this. So over 10 years, I'm going to return the whole 120,000 off because every month I'm written off 1,000 here. You can see every month I'm written off 1,000. Okay, by 10 years, I'm basically written the whole 120,000 off. All right. So again, if the bond is issued at the premium, we are going to recognize expenses that's smaller. Look at our expenses. That is smaller than the interest payable. Why? Because we receive money upfront that's more than the principal indicates. We count that as a reduction to our expense. Okay, if we compare to the issuance at the par value, when bond is issued at the par value, we debit interest expense 10,000, we credit payable 10,000. There's no difference between the two because we didn't receive more money upfront. But when the bond is issued at the premium, we actually got more money upfront. That is basically a reduction to our expenses. So we want to debit an expenses that's smaller than how much we are going to really pay in cash. Okay. All right. Finally, retiring a bond. So when we retire a bond, we are going to debit the bonds payable. We are going to credit cash. So we are going to pay back cash. We are going to debit the principals of the bond. because we are paying it earlier, we have some loss. That's $5,000 we need to record. Okay, so I'm gonna stop here. For the discount case, you can use the similar logic to calculate the bonds expenses and the bonds payable for the 10 years case. But the idea is that if your bond is issued at the premium, it is a reduction to the expenses. If it's issued at the discount, it is basically an increase to the expense. Okay, I will leave that to you to figure out.